Assalamu alaikum wa rahmatullahi wa barakatuh. Bismillah ar-Rahman ar-Rahim. Alhamdulillah. Alhamdulillahi Rabbil Alameen. Wa salatu wa salamu ala nabi al-Amin wa ala alihi wa sahbihi ajma'een wa tabi'ina lahum bi ihsanin ila yawmiddin. Dear Dr. Salman Ahmed Shaikh, distinguished guests, brothers and sisters, ladies and gentlemen, this is our pleasure to welcome you all to this special webinar. And we are very much happy to have Dr. Salman Ahmed Shaikh today as a part of our activities and events of Nadil Iqtisad al-Islami, which is under the purview of Kuwait University. And we, as you know, we are having various types of events and webinars, seminars, conference related to Islamic banking and finance, strategic management, wealth management, financial management, and many other contemporary issues are being covered by our activities under the Nadil Iqtisad al-Islami. So we are very much happy to welcome Dr. Salman Ahmed Shaikh, who is the project coordinator and editor, Islamic Economics Project, editorial advisory board member, Emerald International Journal of Islamic and Middle Eastern Finance and Management. And Dr. Salman Shah also has a PhD in economics from National University of Malaysia and Masters in Economics from Institute of Business Administration, Karachi. In Islamic Economics and Finance, he has published papers in SSCI, Scopus, and ERA Index journals, along with chapters in books published by Web of Science publishers. He has presented in international conferences in Turkey, Malaysia, Japan, Brunei, Indonesia, and Pakistan. And Dr. Salman is the recipient of 2 Emerald Highly Commended Paper Awards. He is also editorial advisory board member of Emerald, indexed in SSCI, and editor of Moral Reflections on Economics, which is a monthly periodical published by Islamic Economics Project. So this is an honor to welcome Dr. Salman Ahmed Shaikh to conduct today's lecture entitled Shari'ah, Screening in Stocks, Rationale and Implications. Please welcome Dr. Salman. I think Dr. Salman is here. So welcome, Dr. Salman. You may start now, please.
Yes, can you hear my voice?
Yes, you can start now, please.
All right. Bismillah ar-Rahman ar-Rahim. First of all, thanks to Kuwait University and Professor Dr. Muhyiddin for inviting me again to this series of webinars on Islamic finance. And today our talk is going to be about stock screening principles in Islamic investments. What is the significance of these stock screening principles, how to apply them, and what differences do they create in the investment decisions of faithful investors. And if we apply those stock screening principles, can we still manage to have sizable return or competitive returns in comparison to the other investment options which are out there? So today I'm going to talk about what are these stock screening principles, how to apply them, what is the rationale of these stock screening principles, and if we apply these principles, are Islamic investments after applying these principles still competitive against the conventional investment options or not. So I would focus my discussion through the lecture slides that I have prepared. Professor Mohyuddin, is it possible to share the slides on screen? If the slides can be shared, I think it will be better for the audience to have a look at the different things that we are going to discuss in this webinar. Professor Mohyuddin, are the slides with you? Can you open them from your end? All right. Thank you for sharing the slides. First of all, we are going to talk about what is the significance of financial important. Then we are going to talk about if we are making investment decisions, the distinct correct overall
Dr. Salman, your voice is not clear.
All right. Let me try to speak loudly. Can you hear my voice now?
No, yes.
All right. We are going to talk about what is the importance of financial investments and what are the important principles in Islamic finance which govern the investment decision making. What are the principles that are being followed and what difference these principles create in the investment decision making process. And then we are going to talk about what are the stock screening principles which are being followed all over the world. What is the S&P criteria, what is the FTSE criteria, what is the Dow Jones criteria, and what is the difference between all these criteria, and what are the principles which basically underpin these criteria which are being followed by Islamic investment decision makers, be they individual investors or the institutional investors in the form of banks and Islamic mutual funds, and also takaful companies. And then we are going to talk about what is the requirement of income purification or dividend purification, what is the stand of AOFI on dividend purification, what is the recommended procedure to ensure that income is purified, and if this principle is followed, what is the implication of this principle on the overall return on the Islamic investments. And then I would also touch upon the empirical literature on the performance of Islamic investments. And finally, I would also present one empirical evidence from my own study, which looks at the comparative evaluation of Islamic investment indices all over the world, including the European region and the GCC region and other regions before COVID and also after COVID. So let's start. Can we move forward one slide ahead? Yeah. So what is the significance of financial investment? So we all know that when we have surplus resources, we want these resources to grow, because if we would keep them idle, we would in Islamic finance have to pay zakat on those resources. And also if there is a high inflation in the economy, then the purchasing power of our surplus resources would go down with the passage of time. So in order to have enough return to manage the positive rate of inflation and to also ensure that our wealth is not deteriorated due to the obligation of zakat, and if we would look to make investments. And while making investments, what the investor wants that yeah. So if the return level is same, the investor would like to the investments with less risk investments. So what I told right now is just a common between Islamic investments and also conventional investments. What is the difference that happens when we are doing investment in Islamic finance? The difference comes in the choice of investment choices. So for instance, in conventional investment options, investors can invest in conventional interest-based deposits, conventional bonds, annuities, and also the insurance plans offered by life insurance companies. So all of these things are permissible in conventional finance space. But when we are making investments in Islamic finance, we have to ensure that we are able to avoid the element of interest, element of gharar in the investment contracts that we are choosing. We also need to ensure that we are able to avoid the element of maisir. So our investment should be free from gambling element, speculation element, and also the interest element. So that is why the investment choices which are available to the Muslim investors would be different as compared to the choices which are available to an investor who is neutral about whether to invest in Sharia compliant or any other kind of financial security. So the first difference comes in Islamic investments is that the investment choices are different for the Sharia compliant investor to the investor who is looking to basically manage investments in a Sharia compliant manner. Another difference which comes, which we would see in the later slide, is the income purification. So in Islamic investment principles, it is said that if we are, let's say, generating some return from our investments in which there is some portion of non-compliant income, and if let's say this is not coming out of core operations of the investment undertaking, but it is still part of it. Let's say if we are investing in a halal stock and the company is also generating some other income by having investments in an interest based option, then if we know that if let's say 1% of the total income of the company is non-compliant, then if let's say this company offers dividend income to us, we need to purify the non-compliant income from the dividend that we are receiving in order to make our return Sharia compliant and halal. So this is the second difference which comes in Islamic investments. The first difference is that the investment choices have to be Sharia compliant. They have to avoid the element of interest, maisar, which means gambling, and the element of uncertainty, which means gharar in Arabic. And the second difference in Islamic investments is that all the investment income that is coming in has to be purely Sharia compliant. It has to remove the element of any Sharia non-compliant source of income. So now we are going to look at what are the stock screening principles which are followed globally. So if we move forward few slides, we can look at that. So I have already discussed this slide. Can we move forward? Yeah. So what is the Sharia compliant governance framework for Islamic investments? So there are two, you can say, steps that are being followed in ensuring Sharia compliance of investments, especially when it comes to stocks. Why stock screening is very crucial among all the investments? Because other investment options are screened on the basis of their structure. So for instance, conventional bond is never Islamic. No matter what the coupon rate is, no matter what the feature of coupon is, whether it is paid semi-annually, annually, monthly, whether it is paid with annuity due concept or with a annuity ordinary concept, it does not matter because the instrument itself includes the element of interest. So no matter what the coupon rate is, no matter what the frequency of payment is, no matter what the maturity of the instrument is, it is non-compliant because of its product structure, because of the nature of the contract, which is not free from interest. So when we evaluate investments in fixed income category and we find the element of interest, we say that the instrument is non-halal, no matter who is issuing it, no matter what the maturity and the other features of the instrument is. But when it comes to stocks, what happens is that a stock is basically representing equity financing, which in principle is not disallowed from Islamic finance principles. So if you look at equity financing, partnership, or limited liability partnership, all of these things are consistent with Islamic principles. But when we look at the stocks, we also need to look at what is the core business of the company who is issuing that stock. Is the core business of the company halal or not halal? And if the core business of the company is halal, then whether it is engaging intensively in certain contracts which involve the element of interest and involve the element of maisar and involve the element of gharar. So if let's say there is a company which is making fertilizer, but in financing its assets, it is intensively using the debt-based financing, and the debt is generated through interest-based contract. So if let's say the assets are financed through interest-based debt intensively and to a very significant extent, then it is possible that the company would be considered as Sharia non-compliant because of its intensive use of a Sharia non-compliant contract to manage its assets, to manage its capital structure. So the first thing that we need to look in stock screening is to see whether the core business of the company is halal or not. So by that count, we would discount, or you can say we would avoid the stocks which are being offered by conventional financial institutions, like the stocks of conventional banks, the stocks of insurance companies, the stocks of mutual funds, conventional mutual funds. So all of these stocks which are offered by companies which are having the core business which is not able to avoid the element of interest, and gharar. These stock investors, whether individual investors or whether institutional investors, would not invest in stocks of conventional banks, insurance companies, conventional mutual funds. But if let's say there is a company which is in the core business of making fertilizer, making automobiles, making cement, making other such products which are not considered as Sharia non-compliant. So for instance, if there is a manufacturer which is engaged in the business of making textile, so it is not engaged in a core business which is Sharia non-compliant. Then we have to see the quantitative part of the screening. The qualitative part of the screening looks at the core principles. If the core business of the company is halal, then the company is investable for the investor. The stock of the company is permissible for investment for the faithful investor. But we also need to look at some quantitative criteria. Now, in quantitative criteria, there can be three approaches. One approach is that we only look at qualitative criteria, we only look at core business of the company. If it is halal, then we do not really bother about quantitative criteria. So for instance, one flexible way could be that we would allow investment in stock of any business which is engaged in a core business that is Sharia compliant. For instance, textiles, cement, fertilizer, automobiles, and so on. The other conservative approach is that no, if we are looking at the eligibility of investment from the Sharia point of view, we should be conservative and we need to evaluate each and every contract, each and every transaction of the company. If it is engaged in any non-compliant transaction, any non-compliant contract, then we ought not to invest in such a company. So this is a conservative view. If we take the flexible view, we would only engage in qualitative screening and not engage in quantitative screening at all. But that is not ideal, because then we would be promoting or engaging in certain businesses which are intensively engaged in interest-based financing, interest-based investments. The other approach is that we become very conservative and look at each and every transaction. So that approach is also not quite ideal or practical, because we cannot evaluate each and every transaction. We are just reliant on the financial statements which are published by companies themselves. So it is possible that we do not have all the information to evaluate each and every transaction and each and every contract. And we cannot be very conservative in the sense that we deem investment in a company as Sharia non-compliant only because of one transaction or two transactions or few transactions. So scholars devise a balanced view that we need to look at whether the company is engaged intensively in interest-based investments, interest-based financing, or getting a larger of its income from if as Sharia. But if it is not case, if in yes, sorry, I was disconnected for a while. Can you hear my voice now?
Yes, Dr. Salman.
Yeah, yeah. So I was saying that we have three, you can say, approaches to look at stock screening. One approach is that we only look at the core business of the company. If it is halal, we say the company is halal. The other approach is that we ought to look at all the transactions and contracts of the company, and all the transactions and contracts of the company should be Sharia compliant for it to be considered as Sharia compliant investment option. This is a conservative view. The balanced view is that we need to take the middle ground. We need to not provide all the flexibility in the world, and we also need not be conservative to the extent that we are looking at each and every transaction and contract of the company to judge the Sharia compliance. So what the scholars decided that we can have a balanced approach whereby we would look at what is the intensity of usage of, let's say, interest-based financing in financing the total assets of the company. What is the intensity of usage of interest-based investments while making investments in the company, and what is the intensity of or the significance of non-compliant portion of income in generating the total income in the company. If, let's say, the company is using interest-based options but not to a very significant extent, then we can consider that company to be Sharia compliant. But what we will have to do is that we will have to ensure 100% income purification. So if the company is having 2% of its income from non-compliant sources, when it pays dividend, the dividend should be purified from the non-compliant income, and all the non-compliant portion of income should be paid to charity for the income to become Sharia compliant and for the investments to remain Sharia compliant. So this is the view of scholars, and based on this view, certain stock screening principles have been developed all over the world. So here in this diagram, you can see that S&P has its own criteria, FTSE has its own criteria, Dow Jones has its own criteria. So if you look at these criteria, they are looking at some quantitative indicators. So the first principle was to look at just the core business of the company. That was qualitative evaluation. But when the qualitative evaluation is passed, then we have to look at the quantitative indicators. For instance, how much is the proportion of interest-based financing in the total assets of the company? How much is the non-permissible income in the total income of the company? How much is the proportion of interest-based investments in the total assets of the company? So these are the criteria related to leverage, liquidity, revenue. And then when these criteria are followed and the company is within the limits set out in these principles. So for instance, one principle says in S&P that leverage of the company should be less than 33% of total assets. Debt to market equity must be less than 33%. So if we take the numerator and market equity the denominator, then this ratio should be less than 33%, meaning that not more than 1/3 of the equity is basically generated as debt. So if we have market value of equity, not more than 1/3 of it should be the value of interest-based debt. Interest-based debt should be less than that. If we are able to ensure that, then the company is complying with the leverage principle in the S&P. So in these quantitative indicators, all the principles have to be followed. Let's say if the company is compliant on leverage but not on liquidity, if it is compliant on liquidity but not on revenue, then the company would still be considered as non-compliant for investments. And finally, if let's say the company is compliant on leverage principle, the liquidity principle, the revenue principle, is still it is required that if let's say there is a non-compliant portion of income, non-permissible portion of income in the income statement of the company, then when this company pays dividend to the investors, this non-compliant portion has to be purified. And AOFI, which is a accounting and auditing body for Islamic financial institution, has given a very specific formula and standard related to how to basically purify that. So I hope that this table is clear to the audience. So if you look at the difference between S&P criteria, FTSE criteria, Dow Jones criteria, the difference is very minor. So for instance, in S&P and Dow Jones, the difference is that when they are computing the debt to market equity, they are taking the 12-month average in S&P, whereas in Dow Jones, they are taking the 24-month average. So there is just a minor difference between these, you can say, criteria, but still sometimes these minor differences can create a practical confusion, a practical challenge, which is that maybe sometimes a stock is Sharia compliant on S&P but not on Dow Jones. If it is compliant on FTSE, it is compliant with S&P, let's say. So when that happens, the problem comes that what do mutual funds do, or what do Islamic banks and Takaful companies do? If they, let's say, follow the S&P criteria, S&P criteria might render one company to be permissible, and if they follow Dow Jones, maybe the list of halal stocks would be different, using the different stock screening criteria. So this practical challenge can arise, but this is managed through a priori commitment to a particular stock screening criteria. So for instance, if let's say in a jurisdiction, an Islamic mutual fund is saying that it would follow Dow Jones, then it cannot say in the middle of the period that it is now going to follow S&P. So this should not be done. And that is why there is a strong Sharia governance framework. These principles are there, but they cannot just be with governance framework. In all Islamic mutual funds, there are Sharia advisors, there are stock analysts, and they have to do this screening, but this screening has to be vetted by some regulatory authority. For instance, in Pakistan, the list of eligible stocks for investment for Islamic mutual funds, Islamic banks, Takaful companies, this list is in the country. So the Pakistan Stock Exchange basically has the authority to generate this list of eligible securities after every 6 months. Likewise, in Kuala Lumpur, there is another regulatory authority. The boards has the authority to basically give the list of eligible securities. So the principles are there, but they have to be followed under a governance framework. They have to be monitored. They have to be vetted. They have to be approved first. Then Islamic mutual funds can invest in performance of these investment, you can say options, or you can say investment class of assets in Islamic finance. So for instance, if you look at Islamic mutual funds, Islamic indices, if you look at their performance, what we find is that there are promising results. The concern which some people have that if we follow income purification, our return on asset or return on investment would go down. If we would be restricted to only invest in, let's say, sukuk over the treasury bill, or invest in only particular type of mutual funds instead of all types of mutual funds, or restricted to only invest in some stocks rather than all types of stocks, we might have difficulty in managing our in generating as much returns as the conventional mutual funds, because they do not have to purify their income. They are not restricted to only engage in certain type of investment options. They are not restricted to engage in short selling and also derivatives trading. So Islamic investments, while having these restrictions on the kinds of investment they can make, while having these restrictions on the kind of trading strategies or the trading contracts that they can use, by having the complication or the obligation to purify their income all the time on all their investments, they might be having a challenge and they might underperform as compared to the conventional investments. But the reality, if you look at the empirical literature says that Islamic investments are able to provide competitive returns, and that is universal evidence, meaning that it's not just that this evidence is confirmed in one particular market. In many markets, this evidence is there that Islamic investments are competitive in terms of return, in terms of risk, especially in terms of risk. A lot of studies have found that when the great financial crisis happened, Islamic investments did a better job of absorbing the risk as compared to the conventional investments. And that is because they are having much more absorption capacity due to having more tangibility of assets in their balance sheet. So one of the stock screening principle is that you need to have enough uh, tangible assets on your balance sheet, enough illiquid assets, so that you are able to absorb the risk better. So the stock screening principle is that most of the are in a better position to manage their credit risk and to manage their overall business when, let's say, credit crisis happens, or when there is a crisis like situation in the financial market. So if we look at the evidence in the last two slides which I have, which compares the Islamic investments and conventional investments in the great financial crisis and after the great financial crisis. And I also have a one slide which is comparing the performance period and after the COVID period. So is it possible that you show those last two tables in my slides? The last two tables which are giving a comparison of Islamic investments and conventional investments. If it is possible, if you go through those tables. Yeah. Yeah, the two tables at the end. So one table is comparing the Islamic investments before the great financial crisis, during the great financial crisis, and after the great financial crisis. So what we find in those comparative tables is that Islamic investments had competitive return as compared to conventional investments, but more importantly, they had much less risk during the great financial crisis and also after the great financial crisis. And this evidence has also been confirmed by many other authors that Islamic investments are better adapted to managing the risk, and they outperform the conventional investments, especially in the down market conditions. So when there is a down market condition, when let's say there is a bearish condition in the financial market, a crisis, under these kinds of crises, Islamic investments do really well. They have very low beta or sometimes even negative beta, which enables them to perform better in a crisis-like situation. And this is also confirmed by another crisis-like situation which we went through just recently, which was the COVID-19 period. So in the COVID-19, all investments had a difficult time, including Islamic investment options, but the recovery of Islamic investments were much swift as compared to conventional investments, and the downfall was less sharp. There was a less slide in Islamic investment options as compared to the conventional investment options. So it shows that even though apparently it might seem that Islamic investments are challenging in the sense that there is more restriction on Islamic investments in terms of what kind of investment instruments you can choose, what kinds of trading strategies you can choose, and the obligation to purify the income necessarily. Apparently, it might seem that Islamic investments would underperform conventional investments, but the reality is different. Islamic investments are able to provide competitive returns, and they are able to manage risk in a better way as compared to conventional investments, partly because the Islamic investment options are not having the element of interest and also the speculative element, and also because they are having much better coverage of tangible assets in the balance sheet, which enables the firms to basically manage the crisis in a better way. So for instance, if you look at the literature on capital structure, we find that tangibility, which is the ratio of tangible assets to total assets, if this ratio is high in companies, then those companies, such companies which are having high tangibility, are better able to access the credit markets even in the credit crunch period, and they are also able to manage their credit risk in a better way. So I would like to end my discussion here. If there are any questions, we can take them as well. Thanks a lot for listening, and sorry for the trouble because of disconnection at my end a couple of times. Thanks a lot. Yeah,
Dr.
actually,
Salman?
I thought that if let's say there are I may answer any questions. So if let's say there are any questions, we can take them. Any comments, suggestions?
I think there is no question, Dr. Salman, or anyone raise his hand.
All right. So I would just summarize by saying that Islamic stock screening principles ensure that the investments which are done in Islamic finance are able to avoid the element of interest, even though apparently it might seem that if we would apply these principles, we would have less investment choices, we would have to let go of some very lucrative or very profitable conventional investment choices. But if we look at the Islamic investment options, for instance, sukuk, for instance, the performance of Islamic mutual funds, or for instance, the performance of Islamic indices, what we find is that Islamic stock screening principles are not limiting the profit-making opportunity. They are to provide competitive returns against the conventional investment options, and more importantly, they are able to even better than conventional investment options, because conventional investment options include more risk by engaging more speculative trading through short selling, through derivatives, and by having the element of interest in all the contracts. But Islamic investment options, while ensuring that Islamic stock screening principles are followed, are much better at managing the credit risk and managing the risk in crisis-like situations. So we cannot say that the stock screening principles or the general investment principles in Islamic finance are limiting the investment options. We have replacements like sukuk is a replacement of treasury bill, commercial sukuk or the corporate sukuk are alternatives of commercial paper and also coupon paying bonds. Islamic banks have different investment options for investors having a short maturity preference, or investors having a medium or long-term maturity preference. So to all those investors, Islamic banks have investment products like certificate of Islamic investments, which are of medium to long-term maturity duration, and there are also remunerative saving accounts which enable the investors to have the banking facility as well as able to generate. So as we also encouraging Islamic investments, they are also encouraging sukuk as well. They are also trying to replace sukuk, replace the treasury bill with sukuk by issuing more and more sukuk rather than the treasury bill to manage their public finances. So when this will happen, it will deepen the market. And Islamic investments are also very crucial for other Islamic financial institutions. So for instance, if you look at Islamic banks, they have surplus liquidity at times. So they need to have Islamic investment options in the form of sukuk, in the form of Islamic mutual funds, in the form of different other Sharia compliant investment options are not kept by able to invest in treasury bills and other Sharia. They need
Dr. Salman, we can hear you. Dr. Salman, please open your microphone. Can you hear me, Dr. Salman?
Yeah. Thanks a lot to the organizers for organizing this wonderful webinar. And I hope that some introduction uh, would have been provided about Islamic investments. And I also thank the participants who participated in this webinar. Thanks a lot again for inviting me and for providing the opportunity to share some thoughts.
Thank you, Dr. Salman. And we hope you look you next lecture, inshallah.